Okay, guys, welcome to today's session. This is going to be day one of the Financial Instruments Masterclass. I'm Faiz Khan, founder of Eduhans, where we help aspiring chartered accountants like you, working full-time, studying part-time, prepare for your exams successfully and help you to write your exams with confidence. Um, So what we're going to be covering over the next 2 days. So today we're going to cover a high level overview of the standards itself. We're going to focus on IFRS 9. Then tomorrow we will work through impairment and in the last part of the session, perhaps the last hour, if not a bit more, we will work through an exam, a test question paper. I know which question paper we'll be covering. I'll share it with you guys tomorrow. In the email that goes out tomorrow, I'll share the paper we'll be working through, but it'll be one of the tests, most likely a test from CTA 2. So let's get into it. Just to give you some background regarding financial instruments, what you should know that whether you are in CTA 1 or if you are in CTA 2, financial instruments for test 2 is an account a significant portion. For CTA 1, 100% is financial instruments because the only thing you do in test 2 is financial instruments. When for CTA 2, about 50% of your paper is going to be financial instruments. But what's going to take place, you have three topics that you cover for test 2, which is financial instruments, foreign transactions, and then share-based payments. So just take note of that. Now, financial instruments can account at least 50% for CTA 2 and most likely 100% for CTA 1. So you can understand how important financial instruments is. Now, if we give you an overview of financial instruments, what you should know, there are three applicable standards when it comes to financial instruments. You need to know IAS 32, you need to know IFRS 7, and you need to know IFRS 9. Now you need to know which standards deal with which items. So under IAS 2 helps you define what a financial instrument is. It helps you to define what a financial asset is, what is a financial instrument, and what is an equity instrument. So the job of IAS 32 is basically classifying a financial instrument in terms of a financial asset, a financial instrument, a financial liability, and an equity instrument. That is the job of IAS 32. Then we have IFRS 9. So, then we have IFRS 7. IFRS 7 deals with the disclosure for financial instruments. Now, in the real world, disclosures is huge. In the real world, when you prepare financial statements, yes, you're going to prepare the balance sheet, income statement, cash flow statement, statement of change in equity. But the big one is the notes to the financial statements. And that is where IFRS 7 comes in. It helps you with the disclosures relating to financial instruments. It is huge in the real world, especially for financial services. Then you have IFRS 9. Now IFRS 9 deals with all the calculations, with all how do you, so IFRS 9 is about when to recognize a financial asset and a financial liability, how to classify a financial asset and a financial liability, and dealing with the subsequent measurement. So how do we deal with subsequent measurement? It also deals with impairment. It also deals with hedge accounting and all of those type of stuff. Hedge accounting is not in the scope, so we're not going to bother with it, but we're going to be covering, we'll be covering the big issues when it comes to IFRS 9 financial instruments. So let's get into it. Let's start with IAS 32. It is for you to read the standards. I'm just going to touch on the important aspects. So I'll define the three definitions within IAS 32, and that is what is a financial instrument, what is a financial asset, and what is a financial liability. So a financial instrument is defined as any contract. So a financial instrument is any contract that gives rise to a financial asset in the one entity and a financial liability or an equity instrument of another entity. So that's important. What makes something a financial instrument? If there is a contract and the contract give rise to one entity having a financial liability and the other entity having a financial, sorry, it is the contract that gives rise to one entity having a financial asset and the other entity having a financial liability or an equity instrument. So that's very, very important. So if you want to be able to identify, you need to ask yourself, does the one entity have a financial asset? And does the other entity have a financial liability or an equity instrument? If the answer is yes, then it is within the scope of financial instruments. If it is no, then it's not financial instruments. Very important. Now, if you pay careful attention to the definition, it uses the term financial asset, it uses the term financial liability, it uses the term equity instrument. So that means you need to know what is a financial asset, what is a financial liability, and what is an equity instrument. So the definitions are quite lengthy. I'll give you the common ones. Okay, so you must read your standards. I'm going to give you the common ones within the definition. So for a financial asset is defined as cash or so it is cash or it is um, a right to receive cash or a right to receive another financial asset, or it is an equity instrument. So if you have a right to an equity instrument, if you have a right to cash, or you have a right to another financial asset, or you just purely have cash, then that is defined as that makes it a financial asset. The definition goes on. Now, those are the typical ones. So cash is a financial asset. Um, Equity instruments, if you have an investment in equity instruments, that is a financial asset. If you have a right to cash or if you have a right to a financial asset, then it is also a financial asset. So that's very important. So for example, trade receivables is a financial asset. Why? A company that has trade receivables, they have a right to cash. So just think about Woolworths, think about Truworths, think about Edgar's, think about Foschini. If you go buy clothing on credit using the store card, they have provided you with the clothes. So they will say debit debtors, credit revenue. That debtors is a financial asset in the books of the retailer. Why? Because they have a right to receive cash. You, as the customer, have to pay them cash. So they have a right to receive cash. So trade receivables is a financial asset. So that is, and then your bank balance is a financial asset. If you have if you have an investment in equity instruments, that is a financial asset. So just take note of that. On the other side, what is a financial liability? A financial liability is where an entity has an obligation to pay cash or have an obligation to transfer a financial asset to the other entity, to another entity. So the moment you have an obligation to pay cash or you have an obligation to transfer another financial asset, then you have a financial liability. Like I said, there are further definitions, but those are the common ones we need to know. So it's very important now, at this point in time, as a CTA student, you have covered inventory and you have covered financial instruments. So you have covered inventory, which is an asset. You have covered financial instruments, which is an asset within CTA. However, in your prior year studies, you have covered PPE, which is also an asset. You have covered intangible assets, which is an asset. So you must now know when something is an asset, and then you must be able to know what type of an asset is it. Is it inventory? Is it PPE? Is it intangible assets? Is it a financial asset? So what makes something a financial asset? If it is cash, if it is an investment in an equity instrument, or if you have a right to receive cash, or you have a right to receive another financial asset. So just take note of that. Like I said, the definition goes on. So you as a student now needs to be able to identify what type of an asset you have. Now we go into the meat of financial instruments, and that is IFRS 9. Like every asset, like every liability, basically for every asset and for every liability, there's a cycle that takes place. We have initial recognition, we have subsequent measurement, and then we have derecognition. For our purposes, we don't deal so much with the derecognition because derecognition is quite complex within financial instruments. So we deal with basic derecognition. We don't deal with the full scope of derecognition within this as a newly qualified CA. That you have to cover for yourself when you are qualified and if you work for a financial services company. So we just need to know initial recognition, subsequent measurement, and basic derecognition. Under subsequent measurement, it's all about how do you subsequently measure a financial asset or a financial liability. It is also dealing with any reclassification, and it is dealing with impairment. So those are the big ticket items when it comes to subsequent measurement. At initial recognition, we need to know when to recognize a financial asset or a financial liability. And we must also know at how much to recognize it or to how much do we measure it at. And we also have to ensure how we're going to classify a financial asset. Okay, just give me one moment. I think a student is trying to get a hold of me. Just give me one moment. I just want to send someone a link. Okay. Sorry, there's a few people that didn't get the link, so I just needed to send it to them. So at initial recognition, we're dealing with when to recognize a financial asset, how much to measure the financial asset, and how do we classify it. You will classify it at inception, at initial recognition, and the reason being, and the classification is going to, that will determine how do we subsequently measure the financial asset. So this is critical. The classification is critical. That is what the whole standard, there's a whole method of how to classify a financial asset or financial instrument. So let's go on. Let's start with initial recognition. At initial recognition, for both a financial asset as well as a financial liability, the date you recognize the financial instrument is when the parties, when the contractual provisions become applicable. So when you have a right to the contractual provisions of the contract, then you have a financial asset. Or when the obligations for when the obligations of the contractual provisions become applicable to you, that is when you recognize the financial asset or the financial liability. So at what date? When you become party to the contractual provisions, when the contractual provisions become effective. So at that date is when you recognize the financial asset or the financial liability, depending on which side of the transaction you are on. Then the question is, at how much do you recognize the financial asset? How much do you recognize a financial liability? You will recognize a financial asset or a financial liability at fair value on the date of initial recognition. So remember, when is initial recognition? When you become party to the contractual provisions of the contract. So at that date, you recognize the financial asset or the financial liability at fair value. Now, this is critical. So think about the journal entries. The journal entry will look as follows. If you have a financial asset, the journal entry will look as follows. Debit financial asset. Because remember, an asset increases on the debit side. So say debit financial asset, fair value. And you're going to credit something. What do you credit most likely? You're most likely going to credit bank. Now, in some cases, the fair value and the bank amount is the same. So then we're okay. We're just going to say debit financial asset, credit bank, because the fair value of the financial asset as well as the bank amount is exactly the same. So the journal entry balances. However, there will be an instance where you will say debit financial asset, fair value, and you have to credit bank. And the bank amount and the fair value will not be the same. So take note, the financial asset is not measured using the amount you paid. The financial asset is measured based on fair value at the recognition date. So you're going to say debit financial asset, fair value, credit bank with whatever you paid. Now, those two amounts may differ, and you need to ensure that the journal entry balances. So that balance, that difference between the fair value and the bank amount could either be a loss or a gain. And what do we call this? If it's a gain, you will say credit day one gain through profit or loss. If it is a loss, you will say debit day one loss and you take it through profit or loss. So that's extremely important. So we dealt with initial recognition, when to recognize, and how much. Now we come to the most important aspect when it comes to initial recognition, and that is, how do you classify a financial asset? A financial asset can be classified in one of three ways: either at amortized costs, or at fair value through profit or loss, or at fair value through OCI. So you have three options available to you: amortized costs, fair value through profit or loss, fair value through OCI. When do you do the classification? You do the classification at inception, at initial recognition. You don't do it subsequent measurement. You must classify a financial asset at initial recognition. So that's important to take note. Now, how do you classify? How do you know which classification is applicable? There's an approach that the standard dictates how you will actually go about the classification. And in many cases, for test purposes, you're going to have to discuss this. So you must make sure you know how to write it out, because they will most likely ask you to discuss it, okay? And it carries quite a bit of marks, and they look for key terminology and for key principles. So the whole purpose of classification revolves around two things. Number one, the business model that the entity uses to manage the financial asset. And then number two, it is the cash flow characteristics of the financial asset. So there's two things you have to take into account when assessing what type of classification, whether it's amortized costs, whether it is fair value through OCI, or whether it is fair value through profit or loss. So what are the two things? It is the business model that the entity uses to manage financial assets. And then number two, it is the cash flow characteristics. It is the cash flow characteristics of the financial asset. Extremely, extremely important. Okay. So now, when you look at the business model, you will have to ask yourself, is the company holding? So this is how you start off the classification. We're gonna look at two things: the business model and the cash flow characteristics. So you start off with the business model. The question you ask yourself is the following: is the business model that the entity uses to manage financial assets, is the business model to hold the asset up until maturity, to hold the asset to collect contractual cash flows? So the question is the business model to hold the asset to collect contractual cash flows? That's the first question. The second question is, if the answer is yes, the second question is, are the contractual cash flows solely payments of interest and principal? So if you read, they will use an acronym called SPPI, solely payments of principal and interest. SPPI, solely payments of principal and interest. So that is the two questions you will ask yourself. So how do you classify a financial asset? Number one, it is based on an entity's business model. Number two, it is based on the cash flow, the cash flow characteristics. So when they say, dear student, please discuss how an entity will classify this financial asset, you will start off by saying, an entity classifies a financial asset based on two objectives. One, the business model that the entity uses to manage financial assets. Number two, the cash flow characteristics of the financial assets. That's the first two things. Then you go into the detail. If the entity holds the assets within a business model to collect contractual cash flows, that's giving further detail, and the contractual cash flows are solely payments of interest and principal, or solely payments of principal and interest, then that asset will be classified at amortized cost. So an asset, a financial asset, can only be at amortized cost if two conditions are present. Number one, the business model is to hold the asset to collect contractual cash flows. Number two, these contractual cash flows are solely payments of principal and interest. Only at that point it will be amortized costs. If that is not the case, it cannot be amortized cost. Then it will most likely be, it's going to be fair value. The question is it fair value through profit or loss, or is it fair value through OCI? Now, a financial asset can only be through fair value through OCI if it is not amortized cost, and if in two instances. Number one, it resembles amortized costs. So how does it resemble amortized costs? It will be at fair value through OCI if the entity holds this financial asset in a business model to collect contractual cash flows. And number two, the contractual cash flows is not solely payments of principal and interest, but rather it is payments of principal, interest, and to receive money to resell the asset. So it's extremely important to understand that. So you will, a financial asset is classified at amortized cost. I see the question, I'll see the hand raised, I'll stop now. The financial asset will be at amortized cost if the business model is to hold contractual cash flows, and the contractual cash flows is solely payments of interest and principal. A financial asset will be measured mandatorily through fair value through OCI if the business model is to hold contractual cash flows, but the contractual cash flows is not solely payments of interest and principal. It is payments of interest, principal, and cash flows as a result of reselling the asset. In that instance, it will be fair value through OCI. The second instance, it can be fair value through OCI if it is an equity instrument and the entity chooses for it to be at fair value through OCI. In every other case, the entity will be, in every other case, a financial asset will be at fair value through profit or loss. So that's extremely, extremely important. Someone raised their hand. Can you just raise your hand again? And then you can ask your question, whatever you want. Who raised their hand? Okay, I don't think he's not here. Okay, so before we move on, is there any questions? Anyone want to ask a question?
Yes, sir, I've got a question.
Sure.
Could you please repeat when a financial instrument is classified through profit and loss, through OCI and profit and loss again, the two distinctions?
Okay.
Thank you.
So remember, when you want to classify a financial asset, you must do the two tests, the business model test and the cash flow characteristics test. So you must do both tests, okay? So the first one is, what is the business model to manage the financial asset? And then number two, what are the cash flow characteristics? So the way you ask yourself is it amortized costs? So you first do the amortized costs test. If it's not amortized cost, it can only be fair value. But now remember, you have a choice between OCI or profit or loss. OCI can only be in two circumstances. Everything else would then be fair value through P&L. So there's only one instance where it can be amortized costs if it meets the specific criteria for amortized costs. If it's not amortized costs, it has to be fair value. Now we have a choice between fair value. It's either fair value OCI or fair value profit or loss. It can only be fair value through OCI in two instances. Everything else will be fair value profit or loss. So the question is, how is it amortized cost? How is it fair value OCI? Remember, it all comes down to the business model test and the cash flow characteristics test. So, if a financial asset is held in a business model to collect contractual cash flows, and these contractual cash flows are solely payments of principal and interest, then it has to be amortized costs. Okay? Then it has to be amortized costs. Then it has to be amortized costs. Okay, so that's extremely important. If If it does not meet those two criteria, it cannot be amortized cost. So that means we are left with fair value. Now the question is, which fair value? Fair value through OCI or fair value through P&L? Remember, there's only two instances where it can be fair value through OCI. It can only be fair value through OCI if it is an equity instrument and you choose for it to be through OCI. So if you have an equity instrument and you choose for it to be through OCI, it will go through OCI. Otherwise, if you don't choose, it goes through profit or loss. Then the other instance is where it is mandatorily through OCI if it closely resembles amortized costs. How does it closely resemble amortized costs? Once again, we go through the business model test and the cash flow characteristic test. Number one, it is held in a business model to collect contractual cash flows. So that is the same for amortized costs. It is held in a business model to collect contractual cash flows. But then we go to the second criteria. Are these contractual cash flows solely payments of interest and principal? If the answer is yes, it is amortized costs. However, if the cash flows are payments of principal, interest, and cash flows as a result of reselling the financial asset, then it can't be amortized costs and it will be mandatorily through fair value through OCI. So that's important. So the two instances, it can be fair value through OCI. One, it is held in a business model to collect contractual cash flows, but these contractual cash flows are three things: principal, interest, and reselling the asset. The second instance, where you can choose for it to be through OCI, that is if it's an equity instrument. Now take note, not all equity instruments, it is an equity instrument that you choose for it to go through OCI. So if it's not amortized cost, if it's not one of those two things at fair value through OCI, then it will be fair value through P&L. So that's important to understand. Are we okay with that? Any further questions? Okay, no other questions? Well, I'm going to test you later. You're going to be split into groups just now, and then you're going to explain, you're going to teach me, or you're going to teach us what are the, how you do initial recognition, how you do subsequent measurement, and then de-recognition. So what I want to tell you that is can be 15 marks, eh? 15 marks to discuss classification. So how do you do it? You tell them an entity assesses based on two criteria: business model as to how they manage a financial asset, and then secondly, the cash flow characteristics. They need to give detail regarding cash flow characteristics, detail regarding the business model. So if it's not amortized cost, it can be fair value. It can only be fair value through OCI in two instances. One of it is mandatorily, it's compulsory. One of it is a choice, voluntary. Everything else, if it's not amortized cost, if it's not fair value through OCI, it will automatically be fair value through profit or loss. Okay, so that's important to understand. From a financial liability point of view, classification is always using the effective interest rate. Okay, so for financial liability, it is always using the effective interest rate. That is basically amortized cost, similar to amortized cost. Okay. However, there are options. You have the option to designate a financial liability at as fair value through P&L. So the default position for classification of a financial liability is the effective interest rate method. That is basically like amortized costs. However, you can designate a financial liability through profit or loss as fair value through profit or loss, but there are certain criteria. Okay, it's just not automatic. There are certain criteria for it. So that is classification. When do you do classification? At initial recognition, at the inception date. Okay, so that's important. Now we move on to the business model. Now we move on to subsequent measurement. Under subsequent measurement is how do we subsequently measure a financial asset? How do we subsequently measure a financial liability? The way you subsequently measure a financial asset, the way you subsequently measure a financial liability is based upon how you classified it at initial recognition. So if you classified it as amortized costs, subsequent measurement will be in terms of amortized costs. If you classified it at initial recognition at fair value through OCI, then subsequent measurement will be in terms of fair value through OCI. If you classified the asset at fair value through P&L at initial recognition, then subsequent measurement will be based upon the accounting treatment of fair value through P&L. So if it is at amortized costs, then we all basically know how to do amortized costs. We will do the present value and all of those type of stuff. We're going to get into the details when we do the question, but on a high level, amortized cost is just basically having an interest expense, having a payment. So if you think about amortized cost, if you take out a bond, if you have a home loan follows amortized cost criteria. Why? Think of it as follows. So you are the customer and you go to the bank and you take out a home loan. Okay. From a bank's point of view, they have a financial asset. Why do they have a financial asset? They have a contractual right to receive cash from you, the homeowner. Okay, so they have a financial asset. So at initial recognition, so when do they recognize the asset? When the parties become, when they have a right to the contractual provisions within the contract, and at initial recognition, they will measure the financial asset at fair value. Then, at initial recognition, they will have to classify the financial asset. So how do they classify it? So typically, there's many circumstances in the real world, there's lots of exceptions and so forth, but for our purposes, how they most likely classify a home loan? So basically, the home loan will most likely be classified as amortized costs. Why? Because they are in a contract. The business model is to hold this contract to collect contractual cash flows. Okay. And the contractual cash flows is made up of only principal and interest. So remember the amount that you're paying, that monthly amount that you're paying, the monthly bond amount is basically for interest as well as to reduce your home loan. So to them, it is an amortized cost. So what will be the accounting treatment subsequently? It will be treated in terms of amortized costs. So how do we deal with it? So in the books of the bank, it will look as follows. Every month, let's just talk on a yearly basis, but we know we do it on a monthly basis. So every year so every month when you make a payment, the bank is going to say debit bank. Why? They received cash flow. Cash flow is an asset. Assets are increasing. Assets increase on the debit side. So they're going to say debit, bank. For every debit, there must be a credit. But now remember, that payment in terms of amortized costs is as a result of two things. It is a payment of interest and a payment of principal. So the credit is going to be split between two things, the interest income and the interest income and the principal amount. So they say debit bank, they receive that amount, they're going to say credit interest income, and the leftover, the difference between the bank, the amount that was paid, and the interest will be credit the bond. That's what will reduce your principal amount. The nitty-gritty of the calculations and all of those type of stuff we're not going to cover today. That is, we're going to cover a full question tomorrow where we go through all the different scenarios. So that is amortized costs. Then at fair value through P&L, as fair value through OCI, as we can understand, it is fair value. So all we're going to do is measure the asset at fair value. So if the asset is currently sitting at 100,000 Rand and the new fair value is 120,000 Rand, we need to increase the asset to 120. So if an asset increases on the debit side. So we're going to say debit financial asset, 20,000 Rand. Because currently at 100, we want to increase it at to 120. So we have to increase it by 20,000 Rand. For every debit, there will have to be a credit. The credit is a fair value gain. Where does this fair value gain go to? It goes through OCI. Okay, so that's important to take note. Similarly, the same journal entry will take place for a fair value through profit or loss. However, the fair value gain will not go through OCI. The fair value gain will go through P&L. Okay, so that's important to take note. There will be one complication when it comes to an asset that is classified mandatorily at fair value through OCI. Which one is classified at fair value through, which one is classified mandatorily at fair value through OCI? It is the financial asset whose business model is to collect contractual cash flows, and the contractual cash flows is payments of principal, interest, and the resale value. Sorry about that. The resale value is a contractual. So the contractual cash flows is the contractual cash flows is payments of principal, interest, and the resale value. So in that case, there'll be a bit of a complication. Part of it is treated like amortized costs, and part of it is treated like as fair value through OCI, but we will deal with that tomorrow in a specific question. I'm not going to deal with it now because we're not doing a question, so just abstract, you're not going to understand it. When we do a specific question, it would be, when we do a specific question, you will see it from that side. What you're saying, wouldn't it be interest expense? Remember, I dealt with it from the financial asset perspective. So you make interest income. If it's from the financial liability perspective, it'll be interest expense. Okay. So just keep that in mind. Okay. So that is subsequent measurement. Yes, someone want to ask a question? You can ask a question. Who's raising their hand? You can ask your question.
Hi. Hello, can you hear me?
Yes, I can.
Okay. Just a quick question. I missed on your point when you were speaking about assets which are mandatorily classified as fair value through OCI. If you can just come again there, please.
Okay. So remember, a financial asset can be classified in three ways: amortized costs, fair value OCI, fair value P&L. So most financial assets will be classified as fair value through profit or loss. There are only in then we have instance of amortized costs. Something can only be at amortized costs if it is a loan or a receivable and it meets the amortized costs criteria. It is held in a business model to collect contractual cash flows, and the contractual cash flows is solely payments of principal and interest. So if you have a loan and a receivable and it meets the criteria of amortized costs, then you will recognize it, or you will classify it as amortized costs. Then, if it does not meet the criteria of amortized costs, we will have either fair value through OCI or fair value through profit or loss. It can only be fair value through OCI in two instances. Okay, it can only be fair value through OCI in two instances: a mandatorily fair value through OCI or a voluntarily OCI. You can voluntarily choose to classify a financial asset through at fair value through OCI only if it is an equity instrument. So if you have an investment in an equity instrument, you can choose for it to be measured, to be classified at fair value through OCI. Once you make this choice, you can never, ever, 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 ever change your mind. Okay, it's going to stay at fair value through OCI forever and ever until you obviously get rid of it. The mandatorily one, so, a financial asset will be mandatorily classified at fair value through OCI if the business model is to collect contractual cash flows. So number one. Number two, the contractual cash flows are made up of three things. It's made up of the payment of principal, the payment of interest, and a payment as a result of reselling the asset. So if you're making money, if you choose to also resell the asset, then you can't have that amortized cost. It will be mandatorily measured or classified at fair value through OCI. So in all instances, in every other instance, it will be at fair value through profit or loss. So only loans and receivables can ever be at amortized cost if it meets the criteria of amortized costs. The mandatorily fair value through OCI is also only applicable to loans and receivables if it meets the criteria of the mandatorily classifying it at fair value through OCI. The other OCI option is only applicable, it's only possible if it is an equity instrument. Everything else, every single thing else will be at fair value through OCI. So loans and receivables can be at fair value through profit or loss. Sorry, everything else will be at profit or loss. So loans and receivables can be through profit or loss if it does not meet the criteria of amortized costs, if it does not meet the criteria for the mandatory classification of fair value through OCI. Equity instruments can only be OCI or profit or loss, fair value OCI or fair value through profit or loss. It will only be fair value through OCI if you choose for it to be so. Every other instrument will be fair value through profit or loss. So just take note of that. So that is classification, and that is subsequent measurement. How do you measure a financial asset subsequently? It will be measured in terms of how you classified it. We will do an example of each one tomorrow. I've chosen a question where we'll cover each one, so you will see it in action. Then we have another issue when it comes to subsequent measurement, and that is reclassification. So remember, classification takes place at initial recognition. Reclassification takes place at subsequent measurement. You can only reclassify a financial asset if and only if the business model and the cash flow characteristics change. If the business model and the cash flow characteristics does not change, then you cannot reclassify a financial asset. So for example, if you hold an asset within a business model to collect contractual cash flows, and the contractual cash flows are solely payments of interest and principal, then it's at amortized costs. However, if you change the characteristics of the cash flows, so for example, it's now no longer solely payments of interest and principal, but now it also includes the reselling of the financial asset, then subsequently it can no longer be classified as amortized costs. So you will have to reclassify it to be at fair value through OCI or vice versa. So just take note, reclassification happens subsequently. Now, an important aspect regarding reclassification. Reclassification may take place during a financial year. Reclassification may take place during a financial year. However, you only start accounting for the reclassification at the beginning, at the first day of the new financial year. So let's say, for example, our financial year runs 1 January to 31 December. So our financial year is 1 January to 31 December. Let's say on the 1st of July 2020, on the 1st of July 2020, the company's business model changed, or the cash flow characteristics change, or both. Okay. So now it does not meet the criteria as per initial recognition. So let's say we added amortized costs. So it no longer meets the criteria for amortized costs. It now meets the criteria to be classified as fair value through as at fair value through OCI. So now it meets that criteria. So now we have a reclassification. It's no longer it's no longer amortized cost. It will now be fair value through OCI. The important aspect here is that the reclassification does not take place on 1 July 2020. The reclassification takes place on the reclassification date. So remember, the actual model changed on 1 July 2020. But the reclassification is only accounted for on the reclassification date. When is the reclassification date? IFRS 9 says that the reclassification date is the first day of the new financial year. So that means we did the reclassification in the 2020 financial year, 1 July. So the reclassification only takes place in terms of accounting on 1 January 2021. Very, very, very important. So that means for the remainder of 2020, you still use amortized costs, and only from 1 January, you use the reclassified model, which would now be fair value through OCI. So that's extremely important. What's also important to understand is that the reclassification takes place prospectively, meaning, so you have two options, retrospective or prospective. So the standard says you have to apply the reclassification prospectively, meaning you apply the new accounting treatment going forward. You do not go back in time to change anything. Whatever past gains or losses you have recognized, whatever past interest income, interest expense you have recognized, whatever past impairment you have recognized, it will stay as is. You do not change it. You will only account for the change going forward. So that's important to take note. So what could happen in an exam, in a test, is that They tell you a reclassification takes place and the accountant prepares the journal entries. But the accountant does one of two things, or the accountant does both. The first thing the accountant do is to account for the reclassification on 1 July 2020. Now we know that's incorrect because you don't account for the reclassification at when it actually takes place, but you must account for the reclassification at the reclassification date, which is the first day of the new financial period. Secondly, the accountant could reverse any previous accounting treatment in terms of the old classification. We know that is also incorrect. Why? Because the standard says you do not account for a reclassification retrospectively, which means go back in time. It says you account for a reclassification from the reclassification date prospectively. So just that's very, very important. Okay, so that's important to understand. The last aspect is that of impairment. Now, I'm not going to go into impairment in detail today. I'm going to give you a high-level overview of impairment. Impairment will be covered tomorrow, and then in the first 30 minutes, and then we will go through an actual question in the last hour and a half. We will go through a question. We will cover amortized costs. We will cover fair value through OCI, the mandatory one, either separately or as a reclassification. We will make sure there's going to be a reclassification, and we will make sure that there's a fair value through profit or loss. And we'll make sure that there is impairment. So you'll get a feel for the major items when it comes to IFRS 9. The question will not be exhaustive. So you may come to an exam, there's something different, but remember, we can't cover everything. So we're giving you a taste of everything so that when you go study on your own, you have an idea as to how to apply the various aspects. When it comes to IFRS 9 impairment, it is very different from the old impairment. The old impairment was in terms of IAS 39. The new impairment is in terms of IFRS 9. When I was a student, we were using IFRS 9 and IAS 39 because IFRS 9 was not yet complete. So part of it was IFRS 9, part of it was IAS 39. So when I was a student, impairment was not yet complete in terms of IFRS 9. So we did initial recognition and majority of the subsequent measurement in terms of IFRS 9. Then we did hedge accounting and impairment in terms of IAS 39. But now IFRS 9 is complete, so IAS 39 no longer exists. So under IAS 39, they used the, what do they call it now? So under IFRS 9, we use the expected loss approach, whereas under IAS 39, they use the incurred loss approach. The difference between the two is under IAS 39, you first waited for a loss to actually take place, for a loss to actually become evident. Then you accounted for impairment. IFRS 9 says we don't wait for a loss to take place. We base it on what we expect a loss, what we expect losses to be. And why they did this was because of the 2008 financial crisis, where where the world was saying accounting was not done correctly. The approach of accounting in terms of IAS 39 is not the correct approach. We can't wait for something to take place when we already know something may take place. So they changed the model to be now the expected credit loss model, where you recognize an impairment loss based on what you expect will take place, not on what actually takes place. So as a result, at initial recognition, you will recognize an impairment on day one. And then every subsequent year end, you would then update the impairment amount. So impairment is only applicable for amortized costs. Okay. And then the only other exception is it will be applicable when it comes to the mandatorily fair value through OCI. But otherwise, impairment is not applicable to fair value through profit or loss or for any other fair value through OCI. It is only applicable to amortized costs and the a financial asset that is measured mandatorily at fair value through OCI. Also take note, impairment only applies to assets. So it only applies to financial assets. It does not apply to a financial liability. There are three different approaches for for impairment. We will only cover the general and the simplified approach. We won't cover the other hectic one because of the fact that that is not within our scope. You will have to be able to determine which credit loss you're going to use. Are you going to use the 12-month expected credit loss, or are you going to be using the lifetime expected credit loss? So if there is no significant risk, if there's no significant risk of default, you will use a 12-month. If there is a significant risk of default, you will use the lifetime expected credit loss. So in most cases, day one, we use the 12-month expected credit loss. Then at subsequent periods, we will have to, then at subsequent periods, at subsequent financial year ends, we will then assess whether we continue using the 12-month or whether we use the lifetime. If there is no significant increase in the risk, you continue using the 12-month expected credit loss. If it is if there is a significant increase in the risk of default, then you will now no longer use a 12-month expected credit loss, but you will use the lifetime expected credit loss. What is the difference on a high level? It's a little bit more detailed than this, but on a high level, the 12-month expected credit loss is saying what is the expected default in the next 12 months. The lifetime expected credit loss is saying what is the expected default over the lifetime of the financial asset. So as a result, over the next 12 months will be much lower than over the lifetime. And that is why you only use the lifetime if the risk is significant. Okay. I'm going to split you guys into groups. And then I'm going to give you guys 10 minutes. And I want you to give us feedback. So I'm going to split you into groups and then you will discuss it. I'll enter the groups in and out. And then you guys can select one person to provide feedback. So we're about 60. I will split it into 5 groups. Let me just see. Yeah, I think. Okay, so I'll split it about into 5, 6 groups. And then you will discuss initial recognition, you will discuss subsequent measurement, and you will discuss so initial recognition and subsequent measurement, financial assets and financial liabilities. So I'll give you guys 10 minutes and then you guys can select which one you guys can select which who of you will provide feedback. And you will also get a chance to ask me some questions. And then tomorrow, we're going to dive straight into a question. First give a little bit more detail on impairment, and then dive straight into a question. So now I will split you guys up. Okay, so you guys going into the room now. Please join the room. For those who have not joined yet, please join our room so you can be part of the discussion.
I have understood in the class. I'll need your guidance and corrections from you guys. I'll be writing down what I'll be presenting in the class. On classification of financial assets, you said
value through OCI or P&L.
Yes, it's sort of like an elimination method. That's how I understood it as well.
Okay, so the first will be through amortized cost, then you move to OCI. Then if it doesn't meet those two characteristics, then it's automatically through fair value through profit and loss.
Yes, that's how I understood it.
Okay, so that's for initial recognition. What about subsequent recognition?
So that's subsequent measurement. I think somebody commented. I think
solely principal or interest. That's where the similarities are. But then the main differences between classifying them through OCI and amortized cost is the selling portion.
The selling portion in what sense? Sorry, my man.
With classifying financial assets at other comprehensive income, it's the business model is holding financial assets, collecting contractual cash flows, and selling the financial assets.
In terms of it, sorry, man. In terms of it, what is it held for? Is that what you're trying to say?
That's That's what I'm explaining. That's what I'm explaining. Like, so the main differences between OCI and amortized costs is both of them you can hold the financial assets.
If you are saying it doesn't meet, what are the requirements for classifying as an amortized cost?
So the amortized cost, we have to look at what the business model in which the instrument is held and the cash characteristics. So where a business model is solely for payment, where there's contractual cash flows meant solely for payment of interested capital, it then becomes through amortized cost. The difference between amortized cost now and OCI is the payments. When we look at fair value through OCI, these ones are not solely for collection of interest and principal. That's what I got from the difference between amortized cost and OCI. I don't know if there's anyone who got another difference there.
I think he also added that through OCI, the cash flows, some of it we sell some of the financial instruments that we have, so we keep on.
And so
yes, I'm trying.
Are you using shorthand?
Yeah.
Because you'll be presenting, so you'll be talking to your case. So you just have to use shorthand there. So when we're talking business model, you just write BM. When you're talking cash flows, you write CF, right? So that we can move.
Okay.
So
sure.
Where did we lose you? Where are you?
I think on recognition.
Are you at initial recognition?
Yes.
Okay, so at initial recognition, it's going to be at fair value, FV. and any difference between
Hi, Miranda.
Yes.
I think Beverly is saying she has connectivity problems. Maybe you can represent the group in case she fails to. I don't know if it's okay with you.
No, that's fine. It's all right.
Okay.
Is she back though? Beverly, are you back?
So basically, when you invest in the equity, it goes through other comprehensive income.
Okay.
Okay. But I think we discussed like most of it between each other. So you want us to give a shot?
Yes.
I think he's on mute.
The bracket rooms will end soon. I'm closing it now. Okay. Okay, guys, back. So let's go. I just want to get a quick feedback from each. There were 6 groups, so expect 6 people to give some feedback. We'll just go in chronological order, and so that will help me to understand what you guys took from this session and whether there's any gaps or misunderstandings. So room 1, literally you only have 2 minutes, 2 minutes. Quick, it's like doing a pitch, but just that you're giving feedback. So no longer than 2 minutes. So room 1, you can go.
Oh, yes, hi. So I think at initial recognition, we first have to determine when to recognize a financial asset or a financial liability. And I think an entity is to recognize a financial asset or liability only when it becomes party to the contractual provisions of that specific instrument. And I think this is carried at fair value at initial recognition stage. But then we then look at the classification of these instruments. So for financial assets, either carried at amortized cost, fair value through profit and loss, or OCI. And when we are determining the classification, we basically look at two things in assessing our classification. Firstly, that's the business model of the entity, how it treats the financial asset. And number two, the cash flow characteristics of the financial asset. So when we're looking at the business model, we're basically saying, does the entity hold this financial asset to get contractual cash flows? If it does, then we look at the characteristics of that. If the contractual cash flows are solely payments of interest and principal, then this is going to be classified at amortized cost. I think it's also important to highlight that only loans and receivables are held at amortized cost. If not at amortized cost, then it's going to be held at fair value through OCI or profit and loss. If it's fair value at OCI, there's basically a two approach that we look at again, mandatory and voluntary. It's mandatory to carry that financial asset at OCI if we get contractual cash flows and the characteristics of those cash flows aren't solely just interest and principal, but rather carry an element of that resale value payment as well. And then secondly, we're going to carry it at OCI if it's an equity instrument, and we choose to carry it at OCI. Anything else will be carried through profit and loss.
Okay, so that's perfect. You can stop there. Just a few things. Remember, it's not carried, but rather use the word classified. When you talk about the business model, you want to talk about the business model as how the company or the entity manages the financial asset. The word manage you want to bring through. And then when it comes to cash flows, it is how they collect contractual cash flows. Okay, just those small terminologies, then it's all good. So remember so there can only be two instances for fair value through OCI. It is the mandatory one and the voluntary one. The voluntary one is only applicable for equity instruments. And what's important to make mention when you mention this is that if they decide to measure an asset, if they decide to classify an equity instrument at fair value through OCI, they do so irrevocably. You use the word irrevocably. What does the word irrevocably mean? That you can never, ever change your mind subsequently. Once you decide this equity instrument or a group of equity instruments are going to be classified at fair value through OCI, you can never, ever change your mind. Okay, so just take note of that. Then the mandatory one for fair value through OCI, if it is held in a business model to collect contractual cash flows, and if the contractual cash flows is made up of principal, interest, and selling the financial asset. Okay, so then in that case, it is mandatory classified at fair value through OCI. Okay, all that's perfect. Okay, group 2, room 2. Who's, are you speaking to? Hello, am I speaking to?
You are speaking to Moses. Sorry, I didn't have the time to type my name, so I just used the default one.
Okay, so discuss for us subsequent measurement. What did you guys discuss for subsequent measurement?
Okay. For subsequent measurement, actually, because of time, we didn't discuss much about subsequent measurement, but I can share what we discussed. For subsequent measurement, we noted that if we had initially recognized the financial asset or liability at fair value through, be it fair value through profit and loss, OCI, or at amortized cost, then the subsequent measurement should be in line with the initial recognition. We also talked about impairment, and we noted that impairment only applies to financial asset. Financial liabilities are not impaired. We also talked about significant risk, whereby we now have the opportunity to choose between a 12-month ECL or a lifetime ECL, and we noted that a 12-month ECL is only applicable to financial assets without a significant risk. When we assess, when management assesses that the significant, the risk is low, then we can use a 12-month ECL. I think that could be all.
Okay, so I just want to make something clear. So what we discussed, so what you mentioned is correct. I just want to make something clear is that we never went into depth with impairment. I've already covered the aspects that is relevant for what we get tested on. Remember, it's a lot more complex and it's not as simple as I explained it when you do it in the real world, right? So there'll be a little bit more further complications. So we'll touch on that a little bit more tomorrow so that you know how to do it in the exam, but you also know when you go into the real world, how to really think through it. Okay, so we are in a very simplified manner, the way we're doing it for our purposes, but it's a lot more complex. So just so that when you step into the real world, you have a bit of background and know how to actually apply it, we will touch on that aspects as well. Okay, but that's fine. Room 3.
I will represent room 3. We had not agreed as to who will represent. So I'm not sure, where do you want us to start? Because
Okay,
we did
so I need to
only the
talk to me about the
classification.
reclassification.
Reclassification. Oh, okay. So we didn't get to reclassification, but from what I understood when you were presenting, you said we can only reclassify financial instrument if the business model changes, and also if the characteristics of the contractual cash flow changes. However, the change can happen anytime during the year, but they are only effective on the first day of the preceding financial year. And what else? And you apply it prospectively going for, you don't do retrospective adjustments, you only do going forward.
Okay. So we're not the preceding financial year, the next financial year. Okay, so
succeeding financial year, yeah.
Okay, that's fine. Thank you very much. How do I pronounce your name?
Mataka.
Mataka. Thank you very much, Mataka.
Yes.
So that is correct. How we do reclassifications, we'll touch more onto it in terms of at what amounts. But we'll do that, we'll do a reclassification question tomorrow. Room 4. Who's in room 4? Who's representing room 4?
Hi, yes, Tabang from group 4.
Okay, so tell me, what did you guys discuss? High level.
Okay, we spoke about the initial measurements.
Okay, so on initial measurement, what would be the journal entries for initial measurement, if it's a financial asset?
Okay, for a financial asset, we said there, in terms of the journal entries that we would do, there's 2 of them depending on what happens. So on an ideal one, it would be where we say debit the financial asset fair value, and then we would credit bank. This is when the amounts are the same. But if it happens that the amounts are not the same, we would say debit the financial asset, the fair value at fair value, and then we would credit bank because we're making payment. And then if there's a difference between the two, it will now tell us on whether we made a gain or a loss. And we would classify that one as a day one gain. If it's more, then we would credit that one through P&L. And then if it's a loss, we would say debit day one loss, profit and loss, and then we would debit that one.
Okay, perfect. Thank you very much. That's all that I wanted to know. So that's fine. Anything else you wanted to add? If there's nothing else you want to add, then it's fine. That's all I wanted to know.
No, so far we still coming with everyone.
Cool. Thank you. Room 5.
Yeah, it's me.
Nice.
Okay, so we discussed the initial measurement of financial assets and the financial liabilities. So for initial measurement, to first recognize a financial asset or a liability, you need to determine if you are party to the provisions of a contract. And once you are, then you can recognize and classify the financial asset or a financial liability. So the way you're going to classify a financial asset is you first need to look at two characteristics for financial asset or liability. You look at two characteristics, right? The business model in which the item is held, and the way you're going to go manage the contractual cash flows from that particular asset or liability.
So quickly, one thing. So the business model test is only for financial assets. Okay, so the business model test. So testing the business model and the cash flow characteristics only apply to financial assets. For a financial liability is always classified in terms of the effective interest rate, unless you designate it to be at fair value through profit or loss. Okay, so just take note of that. The business model and cash flow characteristics applies to financial assets. Okay.
Okay, cool. So the way you classify your financial asset is three ways. It's through amortized cost, fair value through other comprehensive income, and then you have through profit or loss for anything else. So to determine if it goes through amortized cost, you need to first assess if it's held for purposes of collecting the principal amount and the interest amount, which is contractual inflows. If you are doing those two things, then you recognize it through amortized cost. Right? If it's held in a business model to collect principal cash flows and also to later resell, then you will classify that under fair value through other comprehensive income. If it's an equity instrument, right, that you are holding not for trading, then you classify that under other comprehensive income, and everything else goes through profit and loss.
Just quickly on the equity instrument. So it's not held for trading, that's correct, but you must choose for it to go through OCI. It doesn't automatically go through OCI, okay? So it's only if you choose for it to go through OCI. So even if it's not held for trading and you don't choose for it to go through OCI, it will go through profit or loss. Only if you choose for it to go through OCI, then it will go through OCI, not automatically going through OCI. So just take note of that.
Okay, cool. And then the subsequent measurement, right, has to be exactly aligned with how you initially classified it. So if you classified it to go through amortized cost, then that's exactly the same way you will measure it. If it goes through fair value through OCI, then you will do that in the same manner. And also if it's fair value through profit or loss, anything else that goes to the same manner. Okay. And for financial liabilities, you recognize under fair value or the effective interest model.
Yeah, so just on that, so it's always through the effective interest method, unless you designate it to be at fair value through profit or loss. It can't go through fair value through profit or loss unless you designate it, and you can only designate it in certain circumstances. Okay, so just take note of that. Okay, but that's all I want from you. So I want the other group to do the last, because you group 5, right? Fakir, group 5, yeah. So group 6, who's representing group 6?
I'm representing group 6.
What's your name?
So, Jabu.
Jabu.
Jabu, yeah, Jabu.
Okay.
Jabu, yeah. Should I explain what we discussed, or do you have like a question for me? Or...
So subsequent measurement, impairment and reclassification.
Impairments and reclassification. We didn't get to discuss impairments.
Reclassification.
What we discussed for reclassification is that reclassification only happens when the entity decides to change its business model. And the key thing for reclassification is that it is applied prospectively. And reclassification is accounted for at reclassification dates. And the reclassification dates is the dates, which is it's the first dates of the following year that the reclassification occurred. And also another key thing for reclassification is that in terms of financial liability, the entity shall not reclassify financial liability.
Yeah, so you can only reclassify financial liability only for financial assets. Okay?
Assets, yes.
Yeah, that's perfect. So those are the key points when it comes to financial instruments. So you might just sit back now and think about this and understand what happens at initial recognition. Remember, at initial recognition, you also apply impairment. So just take note. And then we'll deal with what happens at subsequent measurement. And remember, subsequent measurement will be reclassification and there will be impairment and the normal subsequent measurement treatment of your classification. So tomorrow, we're going to do a little bit more detailed when it comes to, I'll look at your question now, Tatenda. Tomorrow, we will deal a little bit more further, just probably like 15, 20 minutes on a little bit more information regarding impairment. And then we're going to do a question. So a question is going to make, I'm going to make sure there's an impairment question. I'm going to make sure there's a reclassification question. I'm going to make sure that there's amortized costs, mandatorily fair value through OCI, and maybe an equity instrument OCI. I can't promise that, but then also a fair value through profit or loss. So then you get to see how all of this comes together. Your side is going to be able to do three things. You must be able to, once you're done and you go re-look at the question, you must be able to be able to discuss, calculate, and perform journal entries. You must be able to do all three: discuss, calculate, and perform journal entries. What we do tomorrow, I can't say it's going to be discussion or whatever. It will be whatever the question is, but you must be able to discuss it, calculate it, as well as perform journal entries. Most of the time it's journal entries and discussion. Because remember, with journal entries, with discussion comes calculation. So they're hardly ever just going to ask you for a calculation. But you will still have to be able to do it, because you're going to need to provide those numbers when you do the discussion and or the journal entries. Okay, Tatenda, you want to ask a question? You can ask.
Abana.
Yes, thank you for the opportunity. Can you hear me?
I can.
You did mention that for financial liabilities, the default classification is effective interest, right? Or basically that means the amortized cost, right?
Yeah, kind of, yeah.
Yeah. And they can be, for financial liabilities, they can be also an irrevocable designation to measure them at fair value through P&L. Is that it?
Yes.
Yes. Okay. So I also have a question on financial. My question is on financial assets. I understand that they can also be an irrevocable designation to measure financial assets at fair value through profit and loss if it eliminates or significantly reduces the measurement or accounting mismatch. I don't really understand what that statement means.
Yeah, okay, so in an exam, you're not going to get that. In the real world, you're going to get it. So what happens, so for example, in a life insurance company, a long-term life insurance company. So in both the companies I worked at, I dealt with long-term insurance, and we had a situation like that by default. Okay, so a situation happens as this: in the long-term insurance industry, there's something known as you either have long-term insurance contracts or you have investment contracts. Now, in terms of so a financial services company, long-term insurance company, is regulated by the FSCA. I can't remember what it stands for, Financial Services Conduct Authority. And together with the Prudential Authority, then we have to provide some regulatory information to those entities. And when you register, you have to select a classification that how the regulatory body decides to classify. So one of the type of investments classifications is something known as a linked investment. So, for example, you as an individual, so so it can be individuals, but it's mainly companies. But let's just say you as an individual make an investment, or you enter into a contract with a long-term insurer. So, for example, like Old Mutual, like Signia, or something of that nature. So you enter into a contract with the long-term insurer. It's a long-term insurance contract. But in terms of this contract, it's not actually a really long-term insurance, but rather it is an investment. And the investment will tell you that it is a linked investment. What does that mean? Whatever money you give, the company is going to take it and invest it into the market for you. And your return is basically based on what the market does after all the fees the company takes. So if you give 100 Rand, they can invest 100 Rand, not exactly 100 Rand because they first take their fees, but let's say they invest 100 Rand. So effectively, if the market value is 150, you have a right to 150 after all the necessary deductions. So for example, any fees, tax, and so forth. Now, they're going to say debit financial asset. They're going to need the credit, which is a liability, which is a financial liability. So if you pick up Signia's financial statements, you will have a line item on the balance sheet called investments, linked investments. Then on the liability section of the balance sheet, you're going to see investments linked to So on the asset side, you're going to see investments linked to investment contract liability. And then in the liability section, you're going to see investment contract liability. Now, technically speaking, the investment contract liability would have to be classified in terms of the effective interest rate method, because that is what the accounting standard says, unless you designate it as a financial liability. Unless you designate the financial liability at fair value through profit or loss. One of the reasons that you can do that if there's an accounting mismatch. So in this case, we would designate the investment contract liability at fair value through profit or loss. Why? Because the investment contract liability is as a result of the investment asset. The investment asset is measured at fair value. So what we do is we measure the investment liability also at fair value. We designate it at fair value. Why? Because if we don't designate it at fair value, there's going to be a mismatch between what the asset has and what the liability is. Because remember, you as the client, you have a right to the investment asset. The company or mutual signature only have an obligation to pay you the investment asset. So as a result, they will designate that as, they'll designate the investment liability at fair value through profit or loss, because now the liability matches the asset, which is the actual obligation. If they had to use the effective interest rate method, then the liability amount, the obligation to the holder, to the investment holder, will be different to the asset, and that causes an accounting mismatch. So a similar scenario would happen in on the asset side. There could be a situation on an asset side as well. I've never experienced it. I can't think of an example. But like I said, in the long-term insurance, this is a typical example where you would designate a financial liability at fair value because your liability is based on the asset. So if you don't have your liability at fair value, it's not going to equal to the asset. So that causes a mismatch. So that is an example of when it will take place. What they will do in an exam, if it does come through, they won't let you identify the mismatch. They're going to tell you that there's a mismatch. So then you must know you may designate it at fair value through profit or loss. I hope that answers your question.
Yes, yes. Thank you. That was a well-detailed explanation. Thank you very much.
Any other questions? Yes, you can ask. I think it's Jabu. Okay, who wants to ask, Jabu or Dauri Kanile?
Yes, I'm trying to see where I can raise my hand.
Oh,
but
you can
for me,
ask,
it's not really, it's not really a question, but to say, how often do you do such lessons? Because the concepts are better and they're explained clearly. So if we can have this concept quite often, or these discussions or these lessons, maybe you can highlight to us how best we can join also on these platforms.
Okay, I will let you know. Are you in the WhatsApp group, in our WhatsApp group, or did you just register via the link on the website?
I've just registered via the link on the website.
Okay. So you will be on our email list. Then you will see regular. We do basically one of these classes, one of these free classes before every test. Okay, so this is the one before test 2. There will be one before test 3 and one before test 4 as well.
Okay, thank you.
Mantla?
Yes, I just want more clarification in terms of the equity instrument, because I don't really get it under the classification of financial asset, the distinction between the fair value through OCI and the profit and loss. If you can please re-explain it.
So, so when a company has an investment in equity instrument, so for example, they invest in shares. So shares is an equity instrument. So if they invest in shares, you must know automatically an investment in shares have to be classified at fair value. But the fair value classification could either be OCI or it could be profit or loss. If the company does not choose to measure it at fair value through OCI, then it will be through profit or loss. So when you invest in shares, that is an investment in equity instrument. So it will generally be classified at fair value through profit or loss, unless the company chooses. You have a choice whether you want to measure it at through OCI. In most cases, a company will choose OCI if it is for some strategic purpose, right? As not part of the gains and not part of trying to make profit or loss. They're just investing it in for a strategic purpose, so they don't want the impact of the shares to impact their profit or loss number. Because remember, the income statement is made up of 2 parts, a profit or loss section and an other comprehensive income section. And that totals to your total comprehensive income. Now that profit figure is an important number for many companies, for analysts and all of those type of things. So many companies don't want that number to fluctuate too much. So you may have some strategic initiative that you want to invest into. So you invest into the shares, but you don't want this to impact. You don't want the gains or losses of this strategic initiative to impact your profit or loss line item. So what you would do, you would choose to take it through OCI. So any gains or losses does not hit your profit or loss line item, it hits your other comprehensive income line item. So then you can still manage your profit and loss as you'd like to manage it. But you will only do this, you will only take it through OCI if they choose to take it through OCI. And if they do choose to take it through OCI, then you can never change your mind ever again. Okay, so Manda, does that answer your question?
Yeah, it does. And the mandatory through OCI, can you please add
So the
on that?
mandatorily OCI, so for it to be mandatorily through OCI, it is if it's held in a business model to collect contractual cash flows, number one. Number two, the contractual cash flows is made up of principal, is made up of payments of principal, interest, and the reselling of the asset. If it had those three, you'll see it's very clear in the question, then it will be mandatorily measured at fair value through OCI. Okay, does that answer your question?
Yeah, no, thank you.
Thanks. Jabu? I think it's Jabu. Is that you? Do you have a question? Your hand is raised. Mantla, Justin?
All right. I just wanted to get back to the question that you were addressing earlier on. So when you are saying the profit figure is a very important figure for analysts and probably the organization as well, the investors, etc. So when you have elected through profit and loss, so I just want to see if I'm looking at this clearly. So now you're doing the market valuation of this equity, these shares at the end of the year. So if it is now going to be a loss, a very significant loss, and it's just a remeasurement gain, or it's just a remeasurement loss, now it is affecting probably a third or half of your revenue, and it's only just a remeasurement loss. Is that what you mean, or the remeasurement loss is not affecting the P&L? It's actually being treated. I just wanted probably some clarity on that.
No, so remember that has nothing to do with revenue. It has nothing to do with revenue. So when we say profit or loss, so for example, if you elect through OCI, the journal entry is going to look like this. Let's say it's a gain or it's a loss, but let's talk from a gain point of view. You're going to say debit financial asset, credit fair value gain. But where does the fair value gain? Where in the income statement do you have the fair value gain? It can either be sitting within profit or loss through other income, or it can be below the line item profit or loss sitting under the heading of other comprehensive income. So a mark-to-market reserve, that terminology is generally used for other comprehensive income. So it will affect other comprehensive income and impact total comprehensive income. But if it is fair value through profit or loss, the fair value gain or loss goes through other income, and other income impacts profit or loss. It does not touch. Revenue. Doesn't impact revenue in any way. But what you will see, these clarifications will all be made clear when we do the question tomorrow. Okay. Lee, you wanted to ask a question? So we'll take the last question now.
Okay, so I want to make a follow-up on the gains or losses that arise when you are accounting using fair value through other comprehensive income. Is there any limit for the losses when the financial asset decreases in value? The limit that you should probably debit on the OCI, or there is no limit?
Until the asset is zero. You can't have a negative, you won't have a negative, what do you call it? So only the limit will be up until you write the asset down to zero. That will be the limit. Okay, so I just want to answer Caroline's question here in the chat. What would be examples of significant risk? So they'll tell you something is significant risk, and an example would be someone actually going bad. Okay, so it's any you actually know someone went bad, someone is in financial trouble, they are being liquidated or something of that nature. So when someone someone actually is in financial trouble, financial difficulty, that would mean there's a significant risk of default. Okay, guys, that's all from me today. Tomorrow, lots of your questions will actually be clarified through answering a scenario. Okay, so I will stop there for today, and I'll see you guys tomorrow. We will send out the link tomorrow morning again, and we will touch on or clarify a little bit more regarding impairment, and then we will work through quite a detailed question paper. I will send the question paper out tomorrow as well. Okay, thank you guys. Bye-bye.
Oh, sorry.
So is it
Yes.
Is it possible to get a recorded this session? Are we able to access the recorded?
I'm going to send out the email on Monday with the recordings. Okay.
okay, thank you. Is it starting at 9 tomorrow?
Yes, 9 till 11.
Okay, thank you.
Okay, cool. Thank you. Bye-bye.
Thank you so much.
Pleasure.
Thank you so much.
Thank you.
Thank you.
Pleasure. Bye-bye.
Bye-bye.
Thank you.
Thank you so much.
Pleasure.
Thank you very much.
Pleasure.
Thank you.
You're the best.
No, thank you very much, man. Yeah, you're a huge help.
Thanks. I'm glad.
Webinar.